Welcome to our quarterly outlook call. This is Satya Pradhuman, Director of Cirrus Research. In this outlook call, the title of our latest report, and again, many of our comments will be coming from the quarterly dispatch report, Quality Bet Amplifies as the Capital Markets Tighten. And really, the message behind this title is that we've gotten used to a world in the last 12, 18, 24 months of expecting the Fed to tighten. The Fed eventually tightens and it continues to tighten. Along comes March and we get this real banking shock where to some degree, the regional banks are more exposed than we think to the interest rate volatilities that we've seen the last year. SIVB being central to that. What this is getting at is that as the market knee-jerk and reacted, what really occurred was the capital markets began to tighten. And to some degree, it's given the Fed a little bit of more room to navigate without being as aggressive. But at the same time, there's still a net tightening that seems underway. So what we want to focus on really here is how does this play out over the next few quarters? And what are the opportunities and risks? In the report, specifically what we're going to cover, we did put an interesting, a few, I would say, indicators on this area of testing for aftershocks. The idea is we are all now on credit watch and we're all very busy looking at all the components of the financial sector to see how much more risk is there in the system, not just in the US and clearly overseas, because as Europe, when we looked at the European markets, that was also maybe more striking. To some of us, I think we all had that sort of PTSD moment of 2007, 2008, the moment Credit Suisse fell under. So in the comments this today and in the report, we'll walk through some of the sort of observations on the credit markets and how are we framing this. This was especially acute to the smaller cap market. So as much as for the quarter, the markets were up about 7% or so. Larger cap growth stocks were up 13%, which is really striking. The Russell 2000 was down 5%. But underneath the surface, as we all know, the regional banks, if you look at the KRE, I think it was off by 30%, give or take, in the full swing of the last few months. And so moral of the story is that a lot of investors have experienced a lot of shocks to the system. The benefit, though, was that to some degree, we started the year with a little bit of rate relief, the idea that, hey, the Fed has maybe running its course. At some point now, they're done. And as a result, we were off to the races buying up 2021 growth stocks, basically large cap growth. And so we'll tackle some of that in this area. But if you step back, if we're right about the capital markets tightening or taking turns, I should say, with the Fed, the quality emphasis we've had for the past year, which has worked really well, it is likely to be amplified, I believe, as we get through this process with the capital markets remaining concerned. Another area we'll focus on in terms of a profit cycle slowdown is where is the sell side? And as best as we can estimate, we think the sell side is behind the curve. To some degree, expectations should potentially roll even lower as we go through this earnings season. There are some exceptions. We'll clearly focus on that. And so to some degree, what we have seen is this massive growth rally. And, I think everyone is anxiously looking to say, hey, is this back to the good old days? And we actually disagree. We think that there's real reason to pause here, that it's possible that maybe it's gotten as good as it can get in the large growth run. Because, if we look at the multiples of the technology sector, we're looking at still quite extreme in the face of where there is a slowdown. And so this idea of technology being cyclical will surface very quickly. So yeah, I think we'll cover a bunch of these elements and let's get started. First and foremost, when we're looking at the portfolios as we plot ahead, we have this quadrant of work that we do. This is really a mainstay of our work. The idea is that we run several growth blends from aggressive growth to quality growth and several value blends from deep value to quality value. Given what our bias is and what the data is telling us, if the market is looking at still an earnings recession possibly, to some degree, this idea about earnings visibility, better balance sheet just matters a lot more. This is exactly what the market's been pricing. But I think with this concern right now, as we're all sort of testing for aftershocks and the banking fallout, I think it just got even better. So if I'm running a growth portfolio, we're still in this sort of GARP quality growth leaning. Why wouldn't we clearly be quality growth? We think GARP actually has an extra dose of valuations in it. We're still in a valuation sensitive market, I think, especially if this word inflation remains at bay. If we're on the value quadrant of running portfolios, it is more of a relative value, quality value world. And as the profit cycle slows, earnings visibility, quality balance sheets matter more. So step back for a second. We all sort of got this dose of credit watch moment in the last few weeks. And, to sort of isolate what we're seeing, bottom line, the US credit markets did back up. It backed up about, I would say about 100 basis points really in total. And it has actually settled a bit since then. In fact, if we go overseas, the ripple effects were a little bit more robust, especially in the UK and in Asia. Looking now specifically within sectors, if we're really concerned with the deep cyclicals like banks, housing, et cetera, when we look at those subcomponents, and the beauty of the US markets is the data is super rich at the sector industry level for high yield and credits. And what we'll notice here is that in the initial wave of the SIVB fears, really spreads had enjoyed a close to about a 200 basis point advantage to the overall high yield market. Within a few short days, this spread just widened sharply and has remained really at that similar level. So what this is telling us is as much as the high yield market has settled back a bit, what we're not seeing is the bank related paper really rallying back. So it's clear people are on their toes and watching this space very carefully. So when we think about the banking sector, as much as these stocks and these groups have sold down sharply, with the credit markets really on watch, it's really hard to sort of chase value, play contrarian while we're seeing this. To just give you a sense of how much this effect was really a small cap effect. When we look to the performance between the larger cap stocks and the larger cap financials, that was sort of like 10-11% hiccup. With the smaller company, it was over a 30% spread between the Russell 2000 and regional bank index. If you take the KRE or our own Cirrus indices, these numbers were very, very drastic. And bear in mind, the outlook for small caps, we're going to talk a little bit about it. We are still, our indicator, our classic profit cycle work tells us, hey, when the cycle's slowing, earnings visibility matters, therefore large cap works. What we're seeing is the value gaps have opened so severely that we're now starting to see some sort of a reversal in the smaller cap story. Ironically, since last summer, the Russell has really outperformed the larger cap by 1,100 basis points, 1,400 for the growth groups until March. So in March, they gave up a good 700 basis points in a single month. But I do think some of the extremes of the larger cap growth multiples are really the risk to the system. One other interesting thing, indicator that I think we've started to look at in the weeks into this SIVB moment was something we coined the SIVB Oscillator. And it's a little bit of a tongue-in-cheek there, but the idea is that if you were to segment the regional bank space between those banks that are really related, correlated to the SIV stocks, how it traded prior to the event, and you look to those regional banks on the opposite end, what do you see? And what we'll see is that during the weeks into the fallout, the SIVB basket really collapsed by 20 percentage points against those banks that were least related. So even though the sector was down as a whole, there's a 20-25% gap between unrelated SIVB group to the very related basket. So what we're doing here now is to use this as sort of like a little bit of a measurement tool for aftershocks. So here's the idea. If this curve begins to increase and rise, as it's been doing the last few weeks, what this is telling us is that equity investors are less worried about the SIVB moment. It's quite possible that they sort of trust sort of the backstops that are in place in the system. And so, however, if we begin to see some event-driven risk or some bank surprises us with write-downs in the next few days or weeks with the earnings season underway, it's possible that this curve begins to roll back over. And if that's the case, then we're really not out of this sort of credit cycle tightening chapter that we're talking about. So these are some of the sort of signposts we're going to be looking at to kind of keep an eye on things, and in terms of how to position on the financial sector, and for that matter, what the fallout is. We talked a little bit about forecasts in the earnings season. One thing to bear in mind when we look explicitly at banks, what's going on here is basically as much as the top line growth had been accelerating with the economy reopening, what we've started to see is the sell side analysts have really pared back their forecast with banks. Now, this is meaningful when you look to the last 12 months, because what we're seeing is that the estimates that were roughly 80% of all estimate changes for the bank group about 6 to 8 months ago was being raised. Very quickly in a 6-7 month spell, that number has really collapsed down to a 20% handle. What does this mean? We've gone to about 80% of estimates being cut currently for the bank space, and this was underway well before the SIVB moment. So I think this is important to bear in mind. There is a tendency when bad news comes out, bad stock prices behave. The question is, do we really over embrace that risk? So this is something that's really important. What it's telling us is unless we get some shocking write-down announcement or some sort of sharing, it's quite possible the earnings for the banks may end up being okay. And that could potentially further stabilize the system. Stepping back more broadly, though, when we look to this marketplace, what is it that's got us sort of like focused on this quality bias, even though, hey, shouldn't we read the room? You've had tech stocks come back sharply. Some of these names, on average, they're up like 20% year to date. And I do think that that's very compelling. At the same time, though, what's occurring here is this is occurring as the profit cycle has peaked and has begun to roll over. This is a big deal because what we may forget is that technology is also cyclical. So the more we call for a recession because you want interest rate relief, the more adverse the effect is on top line growth, and for that matter, earnings in a very cyclical growth sector, namely technology. So this gap, I think, remains, and I think it is the stuff that keeps us a lot more cautionary on this specific sector, which seems to be, the tail that wags the dog right now. In terms of quality, let's take a step back and look at how the market's been treating it. Really, the higher quality bias has really begun to work since I would say summer, spring of 21. This has worked quite well for quite a while. Importantly, though, in the first quarter, what we did see was a pullback in high quality. No surprise if you're going to get the mega cap tech rally, because after all, if we're off to the races, who cares about safety? That said, if you were to look underneath mid, smaller firms, the quality bias that's been underway for the last year and a half or so continues. Importantly, bear in mind, what we're seeing is that quality, most key sectors, higher quality continues to outperform. The main exception is really the area of the deep cyclicals. So energy materials, those are elements where quality has not mattered. And to some degree, that makes sense in the idea that if you've got pricing power, who cares about safety? One additional data point about this sort of earnings profitability to the balance sheet, that the balance sheet matters, is this idea what the Fed is doing. So to some degree, in the recent, I would say the last 3 to 5 months, we put out quite a bit of work on measuring liquidity and its impact upon equities. And the bottom line is that if the balance sheet is growing, if the Fed balance sheet is increasing, then that's generally constructive for equities. Empirically, we show it in the reports. That said, we know exactly where the Fed is going, where the Fed has gone. And as best as we can estimate it, you're probably 3/4 of the way into a Fed action that's removing liquidity from the system. At the heart of this is this idea that we're not so sure that the Fed is done. There's two playouts here. One, let's say the financial sector crisis gets worse, the Fed certainly steps back. But what happens there? You end up having a much tougher capital markets behavior. Credit spreads blow out even further. And we barrel further into a slowdown, not just a profits recession, but potentially a recession or a deep recession. Take that further, what do you get? Even though you get your interest rate relief for some of these larger tech stocks and growth stocks, guess what you also have is weaker and weaker demand. Okay, if you're cyclical, guess what? That's a problem for the highest multiple stocks, which is pretty much where we are here. So this quality bias has been working, and I think the market gets it. It has been really tough to see a straight line just because there is such uncertainty with the signaling. I don't think a lot of portfolio managers have grown up in a world where they had to gauge the Fed on how much they're going to act on inflation. If anything, for the past 20, 30 years, it's been the exact opposite. So I would argue our skill sets are a lot limited here in this chapter. In terms of, what's the fallout on the performance of markets when earnings expectations are high or low, what you'll see is that when we're in the neutral to above average zones, you're really in below average market returns. The only time we get to an above market return world is where expectations are well below normal. As best as we're measuring it, we're still business as usual. So that is something that I do think matters. And I think as this number continues to fade, which we expect more guidance downward, to some degree, we get to a much more interesting absolute return moment. One follow-up comment on the quality comment is the valuations for these groups remain quite constructive. They've climbed quite a bit, but we're below sort of longer term higher levels where they could trade. Mid caps have moved especially well. If we're right that we're not out of this chapter, then I think this continues. One of the points that we've made here about growth and larger growth is this idea that smaller companies are a lot more interesting. Why would we say that? If you look at the valuation comps of this group, what you're seeing is this is now, if we were to look at the very long-term small growth versus large growth multiples, if you go back to as far as the 80s, we are now about one standard deviation below normal for small growth multiples to large growth multiples. This is super important, right? Because what you've got is in the last 2 years, smaller speculative stocks really took it on the chin. Investors have been really slow to question whether they're large speculative growth stocks are a problem. And I think this has created a divide that places us in this position where smaller growth stocks, since last summer, I think, continues to outperform, maybe even with the March debacle that we saw in the smaller companies universe. So what's underneath this? So if we look at now, if we segment critical growth markets and also segment small, large, what you'll see is that in the larger cap area, you're looking at where the multiples now for technology are selling at about 2 times the benchmark multiples. Okay, to give you a feel for that, going back the last 20 or so years, it's averaged at 1.5 or 150% of the benchmark. Today, we're pretty much at 2 times. At the heat of the pandemic peak, we were at 2.2 times. Another area to bear in mind is if you look at the healthcare corollary in large mid, because after all, if I'm a growth investor, if I'm thinking larger caps, then the other choice I've got is healthcare, which, by the way, is cyclically defensive, right? So we've got a super interesting gap that's open here. Now, it's really curious if we take this argument and apply it to the smaller cap arena between smaller growth groups in tech, smaller healthcare, what you're now seeing is the multiples converge. In other words, the smaller tech multiples have really collapsed to below sort of prior peaks in the last 20 years. That is nowhere near the case in large caps. And ironically, the smaller healthcare firms have started to rebound nicely. So really a tale of two cities between smaller and larger groups. So the bottom line, though, in this outlook within the small versus large cap story is that some of the indicators, such as the profit cycle, the credit cycle, these things are telling us, hey, larger companies are in favor. What we're observing, if you dig a little deeper, is the market's done a wonderful job pricing in these concerns. And so to some degree, what we expect as we get towards the end, more of a true end of the Fed really pausing on their liquidity bias, to some degree, you begin to see a resurgence and a broader market. We've already, like I said, begun to witness some of that. Areas also to think about is this area of sort of infrastructure. I'm going to shift over now to a few other themes here that also sort of wrestles with this growth versus value debate and also focus on specific areas. Over the last few years, we've made a strong case to argue for additional focus on infrastructure groups. And what we'll see, especially since the pandemic, post-pandemic moment, the infrastructure groups, as we've measured them, large, mid, or small, all three of these indices have nicely outperformed. In addition to that, we've done some fundamental work to create even concentrated baskets off of these infrastructure bins. And those baskets have done exceptionally well with over a 20% outperformance in the last year, 6 months or so. If we take a closer look at this, when we look at our infrastructure benchmark, what you'll see over the last 6 months, groups such as construction, machinery, equipment and services, trucking, they've all gained roughly over 20% to 50% in the last 6 months or so. Within the infrastructure benchmarks, though, what were the laggards? Integrated telecom, data processing, alternative energy. In other words, the more speculative components of our infrastructure groups have been marginal, and yet a broad basket of these groups have worked quite well. So this idea about infrastructure, CapEx, industrials, we think that really matters as we go through this year. We've also done quite a bit of work to compare technology and industrials. We think this is probably one of the most important areas to focus on, and that is, what is the fundamental industrial spending data telling us? And what we'll see in this period is that during the pandemic, industrial spending collapsed, technology CapEx accelerated. But what we've seen in the last 2 years is more of a stabilization, potentially a slowing underway. No surprise if really what we're also seeing is a profit cycle recession. Conversely, what we're also witnessing is the industrial spending component of CapEx has begun to accelerate. So we think this is super important, and we've seen this before. If you go back to the post Y2K moment, I would argue that the pandemic, the corollary to the pandemic is Y2K in terms of tech consumption. And both of these events really created this additional demand surge of tech consumption going into that peak moment. And what occurred in 2002 to 2008 is, I think, terribly informative for this moment. What you'll see if you go back to that window is that tech spending was effectively stable. In other words, it wasn't terrible. It just wasn't accelerating. And if you look to the industrial space, what you'll see is that industrial spending was accelerating over those subsequent 2003, 2008, 7 window. The question is, if you go back to that window, what was behind it? And what I would argue is that was effectively a massive buildup in China, whether it was cities, rails, everything was really on the spend. And as a result, the global industrial cycle really got kickstarted. Take a look at what happened, though, when you go to the equity market. Guess what? We understand that since the Y2K moment, the technology stocks sold down. But did you know that during 2002 to 2003, they rallied again? But guess what happened from 2003 all the way to 2008? They collapsed. It was not just dead money, but they underperformed sharply. If you look at the industrial space, they sharply outperformed the market over those 4 or 5 years. Again, the economics matters. It's not that the tech sector went to sleep because it was this bearish sell-off. It was because tech consumption data flatlined. Not terrible, it just wasn't accelerating. And to some degree, that's exactly what we're seeing here. We've seen in the last 18 months, 2 years, a massive breakdown in tech performance relative to the market and an outperformance of the industrials in the last 18 months or so. We suspect the fundamentals are in place, especially if this infrastructure build out, we would argue, continues to work. One of the really the linchpin behind this is this idea that if you're in a world of higher oil prices, industrial spending typically accelerates. We've looked at data going back as far as the 70s, and what you'll see is that as oil starts to peak, we begin to witness an industrial spending pickup. As oil collapses, we see the exact same thing. So in other words, what we're not expecting here is sort of like a Ukraine beginning a war moment peak of oil. We're just saying, if you're in a world where commodity prices are higher for longer, then that forces a buildup of industrials. Why is that? Because in terms of capital budgeting, this ultimate debate is either I put it in more servers or I put it in plant equipment. If oil prices, if commodity prices are higher, guess what? Plant equipment efficiency matters, industrial spending accelerates. So I think this is a big deal because it's kind of weaves into the portfolio in 2 or 3 different ways. One, it's terribly important as a growth versus value debate. Clearly, it's a technology industrial debate. And ultimately, it's a growth versus value debate. So take a look at the report. There's also white papers on this subject in the prior year or two. The full build out of the infrastructure index, we detailed that over 2 years ago as we were coming out. At the time, we were hoping we were coming out of the pandemic. We realized that the rebuild, the spending plan that should come under should be fairly significant. We thought it was part of the post-pandemic moment. There is a rebuild. We thought the climate, we thought the underspending in the infrastructure over the last decades would come to play out. What really supercharges this argument is the Ukraine move. In an instant, it really forced all of Europe to rethink its energy strategy for the next decade. So we think we're in a different place, and I think it does materially impact the sectors that we're looking at. And again, to sort of nail this down, What you've got here is a profit cycle slowdown. We are in a quality mode. Stock selection is king. It's no longer the biggest cap wins. In that world, it's a misery for active performance because the benchmark wins. If the biggest names are working, it's a real problem. At best, as what we could see, you have a market that's been broadening the last year. We think it'll continue. We know there's a hiccup in the system right now. We're watching it, and it's, if the dust settles, I think you get right back to this broader market theme and a pretty massive sector rotation that's already begun. On the value front, the quality value portfolios continue to work. We expect the quality factor that drives stock selection across the board. So in short, we're going to continue to test for aftershocks. The idea that if there was an earthquake, the government comes in, helps save people, build bridges, stabilize buildings. But the question is, scientifically, you should also be watching for aftershocks, right? So what are we doing? We're looking at credit spreads across markets and across the financial sectors. We're also looking for interesting things such as where the valuations of these areas, what are the earnings telling us about the groups? What's our SIVB oscillator saying? So those are things that we're looking at. But in short, we think that this is still a quality bet, bias. We think the sell side needs to still further adjust its estimates across most groups, especially some of the growth sectors that we're looking at. And if we're right, we continue to witness an interesting rotation between industrials and tech. So that pretty much does it. Like I said, if you've tuned in late, there will be a replay of this. Many of the observations made today have been taken from our quarterly outlook, the dispatch. And as always, feel free to send us in questions and comments. Thank you.